Thanks for joining today. I know people are still trickling in, but we'll get started with introductions. I'm Meredith Bouchard. I'm a partner in the tech group at Lowenstein. We are an emerging companies venture capital practice, and I head the mergers and acquisitions side of the group, which means I spend a lot of my time selling venture-backed companies and working closely with founders as well as VCs in order to do that. I am joined today by a couple of my friends with whom I often work. I'll let them introduce themselves, but we're here today to talk to a community of largely female founders and leaders about the M&A exit process. We've gotten some questions. Why a session for women? And the answer is we get a lot of questions from women about how this process goes. This information is relevant to every founder and everyone in the C-suite at venture-backed companies, but we're getting the questions from women, and we wanted to provide a community of women in which to have these conversations. We're always happy to talk to men as well, but wanted to create this for you. Please do introduce yourselves in the chat. Drop any questions in the chat. We'll try to get to them. But this is going to be pretty conversational, telling some more stories and sharing some insights which are gendered by nature because of our own perspectives. So we'll probably talk about that a little, but mostly just about the exit process. So with that, Ellie, Joanna, and then Joanna's going to try to guide us through the conversation and keep us moving as well.
Great, thank you. Hi, everyone. I'm Ellie Wheeler. I'm a partner at Greycroft. We're a seed to growth venture fund based in New York and Los Angeles. I'm in New York, but we invest everywhere. 4 core areas where we spend time: consumer internet, fintech, enterprise software, and health tech. I lead our health tech investing. We have an early stage pool of capital as well as a growth pool of capital, so can go from end to end. I spend most of my time oriented at the early stage. I've also been in corporate development at a big tech company, so I was on the other side of this. And was at a private equity firm before that, but I've been at Greycroft for almost 12 years. So that's the most relevant thing. And obviously exits are one of our favorite conversations.
That's great, because exits are my life. So I'm glad it's one of your favorite conversations. I'm Joanna Herman, and I am a partner at Oakland Silva & Phillips. We are a media and technology focused investment bank. We focus on the mid-market. We're part of Oakland's, which is one of the world's largest mid-market investment banks. And I also co-head the TMT practice for Oakland's. And I'm delighted to be here. Thank you. In my background, like Ellie, I have a prior history of being on the buy side. I actually ran corporate development at a couple of large companies, including Thomson Financial and LexisNexis. And so it gives me a unique perspective sometimes when I approach the M&A side, because I've actually been on the other side as a buyer. I also did a stint as an entrepreneur. I ran a company, Librify, that ended up being the ebook platform for Target. We ended up selling to Scribd. And I jokingly say that I had to go back to investment banking for better quality of life. So my hat's off to all of you on this call who are entrepreneurs. I know how hard it is. And we're really excited to hopefully provide some perspective that demystifies some of the exit process, because I think when approached well, there's a lot of painful mistakes that you can avoid, and a lot of obstacles that you can get around. And so with that, I think where we just wanted to start was to lay the groundwork for how does the actual process start. And so the way that we look at it, there's really 2 ways. One, you get approached by a buyer, or 2, you decide for a myriad of reasons it's time to sell. And this can look a little different. So, I guess I will hand it over to Ellie first for your perspective, since you obviously have lived and breathed both on many sides.
Yeah, of course. Yes, as you said, it can start in a whole bunch of different ways, and some of them are ideal, and some of them are a little bit harder, but can get you kicked off nonetheless. The thing that I think people don't do as often as they should is develop these relationships along the way, right? So you often get advice about when you don't need money, have conversations with investors so that, you can kind of develop a relationship over time. You should be doing exactly the same thing with the large companies that are in your space or adjacent to your space, or could potentially be buyers down the road. And that doesn't have to be a huge use of time, but it is something that the best founders do. And, they know who the players are in the industry. They get to know them over time. Sure, they're in the same space, but oftentimes, people worry too much about them being competitive. Ultimately, you need to know these players so that when you end up in a conversation, you're not starting from scratch. That is the most ideal scenario, where you already know the players. Perhaps you get inbound interest and that kicks something off, or perhaps you go out with a banker and run a full process. In either circumstance, you're better off if you've developed some relationships with these players. Obviously, there's also the financial sponsors piece, and that's a little bit different. Go do an auction. I think that matters less. But that's the one thing that if you take away from this conversation, I would say, develop some of these relationships and hire an excellent M&A lawyer, at which point Meredith can chime in.
I appreciate that. So I think it's notable that Ellie shared that she likes talking about M&A. I think there's a misconception among a lot of founders that they shouldn't be talking to their board members about M&A, that their board members just want them growing toward an IPO. And that's not the case. The reality is most of these companies will have an M&A exit, and a good M&A exit, but you have to be strategic about them years in advance. So it's another thing to have on your plate. I agree. Cultivating those relationships early matters. I think cultivating banker relationships early matters too, so that if you're going to go the route of a banker, you already know the person who's been giving you good strategic advice. They will give you advice over the life of your company and not only at exit, because you want to be really comfortable in that relationship. We introduce our clients to bankers all the time. Often it's in response to an inbound where nobody knew you were for sale. Suddenly you're for sale, you need to do a market check. But we also do it much earlier to help guide the process of just socializing with potential acquirers and thinking through the exit. So I think it's both with the acquirers and with the bankers, just way ahead of when you actually think you're going to exit. We do
go ahead.
No,
I think you actually kill two birds with one stone, because as bankers, we are always really happy to make those strategic introductions for you. We know the strategic buyers really well. We're talking to them on a regular basis about other companies we're representing. And it's very easy for us when we meet a new company that we know is not ready to sell, but in 2 to 3 years or more could be an ideal acquisition for one of the strategic players. It's very easy for us to make sure that that company is in front of the right people. So we've forged those relationships already. And I think this can also be very helpful. And I don't want to change topics too quickly, Meredith, I think you had more, but when we come to it, when you're thinking about all the things you need to do to prepare for an exit, thinking in mind of who your acquirers can be. When we were at Thompson Financial, we used to joke that there were companies we think were entirely created to be sold to us. It wasn't far from the truth. They knew that we were a big acquirer and they knew what we like to see. And so they were able to model a lot of their strategic decisions in ways that they knew would increase the value that we would pay for them. And I think that isn't a bad piece of information to have when you're thinking about strategic decisions, when knowing who the players in your space are. And Ellie, you were going to say.
Yeah, the one thing I would add, there's a little bit of nuance to what Meredith said about talking to your board about M&A. I understand the hesitancy on the part of the founders, because at times the vision of we want to go build a world-changing standalone public company can be at odds with we're going to go build relationships for M&A, but it's all in the framing. Because ultimately building strategic relationships in your space is intelligent for all the reasons, and everyone can agree on that. Where it can get tricky and where you may have heard stories that might make you hesitant is, there's kind of off ramps along the way oftentimes, or you'll get really early strategic interest for, say, I'm making up numbers, for say $20 million from a strategic, and you have a venture person on your board who's invested at that price or at a different one, and you've told big story to about what you're going to go build. And if that lead could also potentially be the lead of your next round, and you're particularly excited about this $20 million offer, that's where it can get a little bit tricky. And I don't want to go down that rabbit hole, but I think that's why it's in the framing, because ultimately building these relationships makes a lot of sense and everyone can agree on that. And then if there's ever anything actionable, you have to bring it to your board. So you've got to be having those conversations.
So, when we talk about, board alignment, I think that also brings up is sort of cap table alignment and misalignment. So, you've got a bunch of key stakeholders you have to think about. And, Meredith, I know because we've we've talked enough about deals that sometimes these cap tables can get really messy. And how, how from both a legal perspective and then Ellie, how from a practical perspective, should a founder think about it when they've got misalignment on, when each person on the cap table might think is the right time to sell?
Yeah, Ellie, I'm going to defer to you on this one. This is getting everyone in the boardroom on the same page.
Yeah, look, this is something you have to manage if that's the case, right? That's part of your job to help facilitate. And like a concrete example of when this might happen is a later stage investor comes in at a big price, and you've got a bunch of earlier investors and people on the board who represent those earlier investors for whom a particular outcome would be great. And perhaps it would be less so for the later stage investor, or the timelines are just off. The early stage investors have been in for 10 years and think it's time to send some money back, and the last investor in's only been in for a year, right? Like, so sometimes there's that too. I think there's ultimately these are things that need to be talked about openly, and I think that's one of the problems. People know there's an issue and then it isn't addressed or actually discussed. And it should be. And oftentimes, if there really is misalignment there, you can get creative and start finding outlets for secondary if that's the case, or perhaps that later stage investor wants to buy out some of the earlier investors. So, it's not necessarily an intractable problem. Bigger issues, I think can be more problematic if there's particularly onerous terms on the last money in. That's a bigger issue than having some fundamental differences in price and kind of where the zones of indifference are.
Yeah, I think there are many solutions to get chips off the table for founders and early investors. They don't have to be M&A. Last money in generally needs to be on board for a deal, right? Mm-hmm. They've got the biggest stake, the newest stake, they're on the board. So you need alignment there, and you do need board alignment and support to get through a process. Now, boards want to be founder supportive. They care what you think and what you want for the company, but you have to be having those conversations. I agree with that.
So assuming that the board wants to be aligned with the founder, and the founder is feeling like this might be the right time, what are the factors? And, I know we've talked about this, but what are some of the factors we really need to consider about, when is the right time to sell? And, I could certainly rattle off a few. Obviously, there's going to be some things around competitive landscape that are going to be meaningful, in terms of whether this is the best time. Some of it's going to be because there was an incoming offer and it might be good enough to consider. But then there's this idea that, Ellie, you brought up around inflection points of a business. And I thought maybe you could talk about, you've seen so many businesses go through so many different stages. How do you kind of know when you're at an inflection point, it might be the right time?
Yeah, there's so many different considerations, right? I think the three of us could probably talk about this all day. But oftentimes, I think it's a topic that should be brought up fairly often, particularly in the category of companies that are doing well, but aren't necessarily going to be the next Facebook or Meta or whatever we're going to call it. That ultimately it's going to be a nice outcome for everybody, but isn't necessarily going to be like a fund returner for the venture capitalists. I mean, it's the kind of thing that, so yeah, the inflection points can often be around a certain level of revenue even. So you get to 20 million of ARR, It's a pretty fundamentally different build to get from 20 to 50. For example, in terms of organization, in terms of go-to-market motion. And for some businesses, it makes sense and you're on track and everybody signs up for that. For others, maybe it's going to be a real grind to be able to do so, at which point you're going to have a conversation at like, is this a local maxima for us? Like, is this a time that makes sense for us to go have a few conversations? And some of the times that it's also really clear is if you realize that there's kind of certain breakpoints in value in terms of when the strategics in your space are going to be interested. And, sometimes you can kind of grow above where a lot of those buyers can be. And that's okay. That's actually a good problem to have in many ways. But it is something that you should talk about as you approach some of those points. Again, it's hard to be specific because it is so dependent on the particular company, but oftentimes there are moments along the way where it's worth a discussion.
It's interesting how much what you're saying about inflection point tracks the legal rules around when you do an exit and what exit you do. Everyone who's raised money, many of you are likely Delaware C Corps, the Delaware rules apply. Famous case in Delaware, Revlon, that said you have a duty to maximize return to your shareholders. So at these inflection points, the board of directors has to look at each other and use their business judgment to say, are we better off raising more money? Are we better off selling? Which sale is going to be the best? It's exactly that conversation that the law requires that you have, actually.
Yeah, and sometimes like the real, like the honest conversation is, okay, we can go out and raise more money, but the odds are 3 years from now, we're going to be in roughly a similar spot. You're not going to necessarily get the multiple you think you are by going out and getting a little bit bigger. You'd be surprised how often that's true. And when that is the case, obviously it makes sense to start the process because it is going to take a little while.
And what's really interesting about that, Ellie, is that Meredith and I had talked in the past, and I think Lowenstein is unique in that they actually have a quant function in-house. One of the many things that makes Lowenstein a great law firm to work with that actually can help founders think through some of the numbers on this. So you don't actually even have to call your board or your banker to just think through what could it look like? What could that scenario look like, right, Meredith, in terms of if we take in more money now versus maybe an offer at hand or what we think an offer could be at now and the dilutive nature of all of that and really help.
Yeah, that's right. And honestly, we're not the only law firm that does this. A couple of our peer firms have it as well. You should ask your lawyers if they can help you model it out. If you have engaged bankers, they can help you model it out, but you can see, you should be able to look at what your returns are versus if you were further diluted down through another round, how much growth does it take to get back to the same return for you as a founder and for your earlier investors?
That is a much better way of saying what I was trying to, which is like in those scenarios, you can end up in exactly the same spot in terms of proceeds for everyone 2 years later.
And then something else that we sometimes model out for our clients is this decision between strategic and private equity. Because, private equity also does offer you that second bite as at the apple, as we like to say, so you're not selling everything. They're going to have you roll over some of your equity. And so, there are, and we obviously there's many different slices of liquidity events that you could do that give you some cash on the table, but also allow you to keep running your company. But private equity is one way where you can actually have a control transaction and still keep a piece of your company and have that second payday, but it's a very different transaction than strategic. And so it might be interesting to just shed some light on why this is so different. And I think the personal pieces that go into that decision too, because I think, sometimes when we're trying to assess whether a buyer should be a strategic or a PE firm, we really want to understand where is the founder in that trajectory. Founder burnout can be real. And sometimes a founder is just ready to hand it over to a strategic, help with the transition, and then go spend some time on an island, and that's okay too. That's an okay place to be. You've built something great and you're ready to hand it over. And, I don't know how, Ellie, you want to think about that. I'm sure you've had to advise many of your portfolio companies on these kinds of decisions, as well as think it through from the standpoint as an investor of which decision is better.
Yeah, I mean, oftentimes, one of the differences between being in venture and being in PE is that, the vast majority of our companies are founder driven. And we typically want to be on the same side. So if a founder tells us it's time to sell, we're listening, because they know something that we don't more often than not in that decision, that whether it's something they can articulate or not, we tend to believe them. Okay, if you think it's the time, it's probably the time. Sometimes that conversation can be different. Maybe it isn't the time, but they want to take some secondary and go do something else, right? Like there's certainly things, areas in between and shades of gray. But more often than not, we're going to go along with what the founder wants to do, because we assume that there's some insight that they have that we're not privy to, not being in the weeds every day.
Yeah, I think that's right. And PE deals are changing a little over the last couple of years. I'm seeing far more PE sponsors wanting VCs to roll as well. So it's not only the founders taking another bite at the apple, it's the VCs as well. And sometimes that's really appealing and sometimes it's not really appealing. So that's become a part of the conversation. When I check in with founders I've helped to exit 6 months, a year, 2 years after the deal, I hear pretty consistent stories with the exits to PE. I hear they've never worked this hard. They're re-energized with a new team, new ideas, a lot more capital underneath them. They're working like crazy toward that next exit. I hear when people go to strategics, the more typical story is, this is a lot easier than running my own company. And I'm already starting to dream up my next venture, but you do have all sorts of non-competes and things in place like that. But it's you get a little bit of a breather when you sell to a strategic. So it's a different flavor. It's a harder deal, I will say, to sell to private equity. There's just more to negotiate. It's a more complicated process.
I think it's worth emphasizing how different the expectations are going from being venture backed to being PE owned. It's an entirely different world. And whatever you learned being venture backed is largely irrelevant to your new private equity backed life.
Can you elaborate a little more on that? Because I think that's probably really.
It's just, most people in venture don't really claim to be in finance if they're really honest with themselves. It's more finance than other things, but not truly. It's still a lot of an art versus it being truly quantitative. And private equity is dollars and cents. And the bar is raised for actually being able to forecast your business and hitting your results. And especially over the last few years of excess in venture, and at the very early stages when it's just truly impossible to forecast your business accurately, people are often very surprised at the first private equity board meeting when you come in and are 20% off plan. What happens? You could lose your job in that first board meeting. And that's not the kind of thing that happens for one missed quarter in venture.
So I think that brings up, how do you vet your buyers? Like, I think, you learn a lot about potential buyers in the buying process while there's still time to make a decision. And, sometimes I'm surprised by how sellers, the CEO or the founder can get very focused on the excitement of a deal and not pick up on little cues. And some of those cues, I think, actually, Meredith, come from legal. I mean, now sometimes it's the lawyer driving that, but sometimes we've seen a company, I know you and I have lived this painfully together, being so not flexible, so sort of draconian in their requests. And it can speak to a culture, or and certainly in PE firms, it could speak to demands that they're going to put on a founder. And I'm wondering if you want to speak a little bit to that.
Yeah, I mean, I've had these conversations with both of you of trying to figure out who's calling the shots on the buyer side. Is this a legal issue? Is this a corp dev issue? Trying to figure out, is this a problem we need to think about versus one person's personality we need to navigate around? But you do learn a lot about your buyer, right? It's a two-way interview the whole time. And I always ask founders to remember you are being interviewed every time you talk to them, but also you get to interview them. I think reference checking buyers is really important. If it's private equity, if it's strategic, can I talk to the last couple founders who you brought into the fold, see how it went for them, and also asking the question, what percentage of your deals that you put in LOI do you actually close? That's a good one to ask. And then you just see how it goes as it unfolds. If you're seeing red flags about the acquirer, but I just think those reference checks really matter. And there are reputations, right? Lawyers, bankers, and VCs can tell you who the good players are and who the ones where it's like, if you have to exit to them because no one else will pay that value, fine, but you're going to have to hold your nose and take the pain.
100%. The only thing I would even add is, yes, how many of them actually close on LOIs they sign? And sub-bullet being, how many of them close on the terms that they signed on, versus, kind of changing that value at the 11th hour.
And this market is really different from the financing market, where it's a really bad look for investors to change terms or pull LOIs. It is not uncommon in M&A.
Yeah, it is definitely not uncommon, but there are some buyers who pride themselves on sticking to their price no matter what. I mean, we've had some really great buyers where things come up and they say, we're going to ride this. It's going to be, we are committed to this deal, and we know who those buyers are. And that's another place where I think you should leverage your banker, is that we've worked with these buyers before, and we can tell you this one is someone who tends to retrade. So let's just get ready. Let's try to be prepared for how we're going to handle it when they retrade. Let's try to, take out as much, as much of the risk as we can. And I think this might be, and we're getting some questions from the audience. I want to make sure we have time for that. But, Ellie, you had mentioned something that is sort of a holy grail when you're in a process, which is being able to have a breakup fee. And we don't want anyone to expect that this is a standard. They're very hard to get a buyer to agree to, but they can be beautiful and there's a few other similar type of mechanisms that I've used that can be really helpful. So I thought maybe you could speak to that.
Yeah, we have had a few experiences with that, that have saved companies. But yeah, it's not necessarily the norm. But, certainly the lawyers and bankers know all of the tricks. But, I had a scenario where company had one strategic LOI signed that fell through. And then we got a second one, and we were going to run out of cash if that one didn't close. And since this was the second one, and we had just been through this with the first one, we negotiated that they would pay us a breakup fee if they walked, and we made sure that breakup fee would give us at least another 12 months of runway. That ended up happening. So they became an investor in us. And 3 years later, that company sold for 10x the value of that LOI. So sometimes it really can work. And there are a lot of, so ultimately that strategic who didn't close got a nice return too. Not that we cared about that. But you just never know. But that's definitely more with strategics. You're not going to get that really with financials, and you're not even going to get it all the time. But there are times where it can, and that can help solve some of these problems that are somewhat unique to venture-backed startups, and that you might have a runway issue.
Yeah, I find it very rare that I win those. I'm very happy to ask for anything for a client, but I always want to set expectations that it's not the norm to get a break fee in an LOI. So you need to make sure you have enough cash runway, because you also can't raise while you're in exclusivity with the buyer. So, and I have had companies go under when buyers have walked. To me, that's why it's particularly important to heavily negotiate your LOIs for M&A, because once you're in that LOI, you lose leverage, and the buyer walks or your investors say they're not on board with the deal. you're just stuck. So you really can't solve for the risk of buyer walking because they've got their own event or their bank melts down or whatever it is, or they find something in their diligence about your company that they don't like that makes them change their mind. But you can solve for getting your investor must-have terms into the term sheet to make sure you're not spending time and money for a deal that's never actually going to happen because you don't actually have alignment on your side. So that to me is the moment of leverage, is before entering into the LOI, and the best protection you can usually get for your company. If there's a situation like the buyer needs to raise financing in order to do a deal, that's when it may make sense to either push for a break fee or to say to a buyer, we'll give you exclusivity. Once you've done that, come back to us then. But outside of those scenarios, it's very, very hard to get that kind of a break fee.
Yeah, I would just say that 100% true, but that's why you need your M&A lawyer hired earlier rather than later, because that is your moment before the term sheet. Bringing people on after the term sheet, you've missed an opportunity.
Yeah, and I think the earlier for everything that you can bring the lawyer on, the better. And so maybe that's a good segue to how important it is to bring lawyers, and I would say bankers selfishly, on earlier so that you don't make missteps. Because there are agreements you may be signing years before you're ready to sell that have clauses that can impact. And there's obvious ones like a right of first refusal, but I'm surprised at how many times companies come to us and say, oh yeah, one of our partnerships has a right of first refusal, but it'll be fine. It's usually not just it'll be fine. It's usually something that can undo a deal. So I don't know, Meredith, you want to start on this and talk about some of the mistakes you've seen companies make and how easily they could have been avoided?
Yeah, I appreciate plugs for lawyers early and often. I think the best way to use a lawyer is not as a scrivener, but as a source of strategic advice. Go to your lawyer with your goals and ask them to help you see around corners. So that's from early on, right? To see the agreements you're entering into and say, yeah, a ROFR is going to be a problem for you down the line, or you think it's a really good idea to issue some equity in your subsidiary entity. That's going to make your exit a disaster. Let's plan a different way to incentivize folks that is going to make it simpler. Option issuance is done wrong all the time and becomes an issue in M&A all the time. Please issue your options promptly after promising them and make sure you have a good 409A. They're not expensive to get, but this burns so many people at the time of exit, and it impacts your employees, right? Who obviously matter. Your buyers care about your employees. You care about your employees. So please do that. Make sure all of your corporate governance is just properly recorded, and bring lawyers in to review your contracts. I know when it's early, lawyers are expensive. You just want to get things done, but making sure you understand who's got the ROFR, who has the right to hold up your deal because they need to consent to your M&A is important. And then that LOI, I think lawyers are the most bang for their buck on LOIs, right? Negotiating the high level terms of a deal. Clients come to me all the time where I haven't done the LOI for them. They hand me an LOI and ask me to execute it. And I can do that, but they may not like the terms, and recutting the terms once the LOI is signed is really hard. It's expensive and you often don't win. So the best thing you can do is make sure you have an M&A expert involved before an LOI process, or if you get inbound interest that you weren't expecting to, at that point, assess, is your startup lawyer the right lawyer for this process?
The only things I'd add are sales tax always becomes an issue in a conversation. Always. And that becomes a issue, and holdbacks and what have you. And then also all the governance that has been pushed off and pushed off and pushed off, things like getting audited financials. You need to have your house in order before you can have a legitimate process and have things buttoned up. And if you actually have all that stuff done, you're in a much better spot for a much faster process.
Yeah, the diligence dive a buyer is going to do is a lot deeper than it is for a financing round. But your financing round is a good start. The data room that you put together for those rounds if you just keep using it, keep organized in that way, you're at a better starting place than if you kind of ignore the need to keep the house in order after the financing round before the M&A.
And this might be a good segue to one of the questions we got from the audience who asked, what metrics should early stage VC investors be looking at when they're evaluating companies? And I guess that the question to that is, how would you guide your portfolio companies so that they stay healthy? And so just like you're keeping your data room up to speed, how do you make sure that you're keeping the metrics that matter front and center? And obviously what those metrics are is going to be industry dependent. But I do think there are some that probably span all industries. I don't know if you want to start that out. I'm happy to chime in too.
Yeah, it does vary pretty widely, but ultimately, if you're building a valuable business, a lot of these things tend to take care of themselves. There will be, and you're obviously solving a problem that's real, but it's often hard to build a valuable business if you aren't solving a real problem. So, build the best business you can, being capital efficient about it, and ultimately, I guess one of the things that has gotten lost in easy equity times, which we're not in anymore, has been, are you building enterprise value on a monthly basis? Meaning, are you actually building something of value with the cash that you're burning, if you're burning cash, right? So if you burned 200K of cash last month, what did you get from it? And just being really honest about if you are truly marching in the right path, as you think about runway and think about future financing and ultimately think about the value of your business, as if you can just continue de-risking the business and building something of value, you're gonna eventually have options. It's hard to say when. Obviously, there's a lot of different things to think about. But I wouldn't necessarily build with a particular outcome in mind. That's tricky. Good luck to the companies who built for Thompson to buy them. Sometimes that works, very rarely. But if you build something of value that people want, then you can be much more in the driver's seat.
I see there's also a question about merger versus acquisition. It's a structuring question. A merger is a way to affect an acquisition, and that structure often makes sense based on tax considerations and what your cap table looks like. If you have a lot of investors on your cap table and you're a C Corp, you're probably going to be acquired via a merger structure. But this is the kind of conversation I like to have at the LOI stage. So I was working with a founder this morning who had an LOI that said, we'll figure out if it's a merger or asset deal down the road. And I was saying to her, we really need to do this now because here's the tax difference. And it's enormous if we do it as an asset deal. So don't think of it as a choice between the two. Your lawyers should guide you to the right one, and you should pin it down early because it does matter.
So I want to just go back briefly to what Ellie was speaking about in terms of thinking about value. And I think while there's no specific metrics, I think you can say that are across the board for every company besides sort of the fundamentals, that you're growing, that you're retaining customers, whatever that means. But I do think, and actually our CEO wrote a book called Quick Value. I do think smaller companies don't think about their value as much as they should. I mean, obviously, if you're in a large public company, you're living by your enterprise value. And it's actually relatively easy to get a back of the envelope of what value you're creating on a regular basis, whatever that is, whether it's quarterly, whether it's annual, just to take the time to say, how are other companies trading? And sometimes what shocks me is when I come in and a company tells me, here's what we've created, and it's a great business, and here's our growth strategy, and the part they're growing is the part that no buyer values. And so you are now growing the piece that is going to bring down your multiple. And it just might not be obvious if you're not really thinking about this M&A world, that you're devaluing your company, you're putting all your money into something that's actually taking away value. So I think it is important to sort of have that outside in thought, and it's very easy to get. And again, I will say that any banker who wants to develop a relationship with you, and we all do, that's what we do, we build relationships, we're happy to have those conversations. It doesn't cost anything. And also bringing on a banker early actually doesn't cost very much because, we're very much success driven. So I do think, if there's one thing I would take away from this, it's do everything early. And I think one of the people in the chat said that too. Talk to your board early, talk to your investors early, talk to your lawyer early, talk to your banker early. It helps avoid some of these mistakes. And if we could go back to sort of the mistakes, because I think this is an
I
important.
have a question for you on that. So give us an example there. So that would that be like building out the services org and not building out something else, or
So
give me an example.
ed tech company, it's got a great platform. It's growing really fast. And they also are doing really well with some in-person. In-person's back. COVID's over. In-person's back. Everybody's demanding more in-person. So we're going to meet that demand. It could make sense. But from a standpoint of the buyers, if you're growing your piece of your business is not recurring revenue, that's going to substantially bring down actually all that growth you got in COVID because you actually didn't have the ability to do in person. That growth is, multiples more in your exit value than the growth you're going to have of returning to the instruction-led training.
Right. I do health tech. So that was kind of, we were banging that drum all of COVID. Like you cannot pivot your business to do COVID testing. You will be worth absolutely nothing. Yeah.
Exactly. So the other thing that I just wanted to make sure, because Meredith and I have lived this together, to make sure that we say is the overshare part. I don't think we've fully talked about that, how important it is. I think sometimes founders think that they don't want to share all their dirty laundry with their lawyer, their banker. So it's more than just talk about buying early, but it's share. And I assume, with the board, it's the same thing, share early. We need to know it will come out in diligence. And when it comes out in diligence and we don't know, we can't control it or potentially avoid it. Right, Meredith?
Yeah, everything's going to come out in diligence. So don't not tell people what you think they don't want to hear. Like, we're on your team and we'll help you strategize. So the example I know Joanna's thinking about is we were working together with a founder who didn't want to tell us that there was a dispute with a former founder, and he just went ahead and settled it and told us after it was settled. And I said, gee, I wish you told me, can I see the documents? Because we're going to have to tell the buyer that there's this settlement, and I'd like to see, I want to be able to preview for you what the buyer is going to say. And I looked and said, oh no, this isn't good. We're going to have to reopen this conversation with the former founder because different things are going to need to be signed. And it, of course, then we took it to the buyer. Buyer said exactly what we thought. This doesn't work. And it was much harder than had that founder come to us initially and just said, got this problem. And I would have said, yeah, we definitely need to settle it, but it needs to be done a certain way. We had to do it twice, which was much more expensive in terms of the settlement that had to be paid to that guy. Because when you go back to someone and say, by the way, I need you to sign some extra stuff, they ask for more money. The legal was much more involved. The buyer got much more involved. It eroded trust with the buyer. And it really didn't need to be that big a deal. I think the founder thought by just doing it himself, he was making it not a big deal, but it made it, in fact, an enormous deal that almost derailed the transaction. And that's an extreme version, but there are lots of smaller versions of just anything that comes up, any threatened litigation, any key employee who says they might want to leave, a text message from your CTO saying, screw you, I'm going to sue this company. I don't like what happened today. I've had that happen. Share it with me. We'll find an innocuous way to disclose it if we need to disclose it. But we always want to be thoughtful about our disclosures to the buyer and err on the side of over disclosure, even with the buyer, because we never want to be committing fraud, which sounds like a scary word. But if you don't tell the buyer something that you were required to tell them, that's what it is.
So the other thing I want to touch on is, we talk about oversharing with your advisory team, but who do you share with in the company? Who should be part of the process? And I think we all have different probably opinions on how broad to go or different, experience with how broad people have gone. But I'd love to hear some of your experience and what you think is the best way of approaching who should you tell within a company.
I have had so many founders of smaller companies say, I'm so excited. The team got us here. I can't wait. I'm going to get on a Zoom and tell them all. And then you get the one person who says, I'm so excited for you. Remember that time over drinks, you promised me 10% of the company. So don't tell anyone who doesn't need to know. Core team.
As few as humanly possible. Because the other way of thinking about that is talking about how many LOIs actually fall through. And the answer is an awful lot. There's so many, even let's just talk about strategic. I mean, so many acquisitions that don't make it to the finish line. So you're essentially declaring victory long before you finished. And it's just tough culturally. People start doing the math. Everybody does it. You start creating, you start on how many options do I have? And then they're typing it out. And then you're saying, no, that's not happening. So do yourself a favor and keep it tight.
And then I think that the corollary to that. So I completely agree. I always say keep it tight, although I will tell you that lately I've had experiences where as we're preparing for management meetings, we've realized that something's not working. And then we realize if we just bring in one more person, they're going to bring that missing piece that tells the story. And so I think there needs to be a little flexibility at different points in the process to maybe open it up a little bit more, because you want to put your best foot forward. And if your best person who is going to shine at that management meeting isn't in the know right now, let's talk about whether to put them in the know. But that brings us to stay bonus and equity. Some of these people don't have enough equity to make it exciting for them. And when they hear that you're about to sell your company, the first thing they're going to do is update their LinkedIn profile and start looking for a new job. And so it's really important to think about everybody that's going to be in the know. How are they incented? And would love to hear both of your thoughts on that.
I think you're really aligned with your buyer here. Your buyer wants your best people excited to do the deal. Oftentimes LOIs include sort of the retention package that's going to be shared among management, not always. But I like to have that conversation as we go. I like to understand what a buyer is offering to folks. And there is an opportunity if a buyer is not offering enough to do bonuses to employees on closing. There are a lot of different things you can do with options to make people whole. But I love working with founders who want to take care of their people. There are just a lot of different ways to do it. I always like, if possible, to make that be on buyer's dime instead of coming out of your pocket and the investor's pocket. Happens both ways, though.
It does. Obviously, I prefer it to be on the buyer side and feel like it should be most of the time. But this is always a big point of negotiation. And also one of those moments of like kind of maximum misalignment between the founders, the investors, and the buyer. And everybody knows that, especially experienced buyers. So it's always a tricky point in the process.
Yeah, I don't like to negotiate against ourselves. So I try to not have founders promise anyone anything and just basically say we are pushing with the buyer to get you a great package going forward, and only have looking at closing bonuses that come out of investor proceeds as a last resort if you don't win those points. But if you offer it to a buyer that you want to bonus all these people, they will take you up on that.
It's interesting because, and I guess it's the difference between being the banker, being the lawyer, and being the investor. But I mean, I do find that I push sometimes for stay bonuses that are relatively small when we're talking about what, the consideration. I mean, really relatively small, but are meaningful to the, as head of marketing that you're bringing in, who's now going to give a presentation, who doesn't have a lot of equity in the company, but now feels like, what, I'm really excited to do my best on this management presentation. And so I also think it's important to think about timing to close, because small amounts of money when you're at the management stage or management meeting stage, which, just to give people a sense of process, you usually go through a couple of rounds of evaluating buyers and their offers, and then invite buyers to the second round. The second round is when you would invite them to a management presentation. So at this point, you've vetted these buyers. These are buyers that are real, they're excited, you're excited to potentially work with them. At that stage, there might be a few more people that are worth spending a little bit of money, even though it is going to come directly out of your pocket as the founders, as to actually get them excited to gun for the next 2 to 3 months to just do their best on this presentation and help you get all the information you need to close that deal. And it can
That's
be
right.
money well spent, I think.
And that could be a transaction bonus agreement. You cannot issue options once you have a term sheet, though. Important to note, your 409A is no longer valid. So don't create a problem by doing that.
So I know that we've got only about 7 minutes left, and we wanted to kind of go through a term sheet 101. There was also a question here that came into me about that, like, what about non-CEO co-founders? And I think it's a good question because sometimes you're a founder, but you're not the decision maker, right? And how can you think about future options? I think that's the question. And if the person wants to clarify further, maybe we'll put that on hold. And if you want to clarify further, if I've asked that correctly, because it was sent directly to me. But I do think there's maybe some influence questions when you're deeply involved and you started this company, but you're not in the CEO position, so you're not driving. I think that's what the question is. Yes, that's correct. That is the question.
I don't know, Meredith, do you have a point of view on this? Because I kind of view it as any other executive, right?
Yeah, if you're still a key employee, typically buyers will condition a deal on all of the most important employees currently to the company signing off on the deal. You're not going to be forced into a deal that you don't like, but you may have less influence in the day-to-day, and that really needs to be handled on a case-by-case basis, figuring out who the decision-making team is. Typically I'll work with a small subset of leaders, not limited to the CEO, but key folks on the company side. And then we bring in the board members to make sure that they're aligned with all the decisions being made. But I'm open to a one-on-one conversation on that because I really think it is dependent on the roles and the dynamics within the company.
Yeah, likewise. Again, this is a great time to utilize an advisor like a lawyer or a banker to say, hey, could you start a relationship and say, can you help me think through how do I, protect myself, protect this company that I helped found, even though I'm not the CEO. And we have very often been brought in to be the banker on a deal, and it's not the CEO who brings us in. It's somebody who's involved in the company, knows me or knows our firm, and says, we'd like you to represent us as our banker. So you do even have influence on choosing the banker. It's very often how banking relationships come in.
And especially if you have a large equity stake.
Yes. And I don't know, Meredith, I know we'd want to do like just a quick, because sort of demystifying the term sheet. We've only got a few minutes left. Do you think it's worth just sort of bullet points or just sort of talking about a few of the things that people might not be familiar with that can be?
Sure. So I talked about deal structure being really important. Also adjustments to deal consideration. Your headline price is not what you're actually getting. So your amount of debt, your cash, your working capital are all going to be taken into account. Your lawyers are going to want to spend a lot of time talking about your indemnity package. And that's the possibility that after the deal, you have to give some of the purchase price back. That gets heavily negotiated. So unlike in your financing rounds that are probably based on NVCA docs, there are no market documents for M&A. Everything is specifically negotiated. And so there are different market solves, including insurance policies for this. But you're going to spend time understanding the limitations on when you may have to give back money after a deal. And then the last piece is what's required to get a deal done. What conditions? Are you going to have to agree to a non-compete? Are your investors going to have to agree to non-solicits? Non-competes are enforceable in connection with M&A. They're linked to timing of closing. They're separate from your employment non-compete. They might be as long as 5 years after the deal. And you may also be subject to founder or key employee revesting, which means you have to agree that half or all of your deal consideration is not going to be paid to you for a period of time after the deal, contingent on you staying with the company. That's a lot of things that founders going through a first-time exit don't anticipate, but it's getting pretty common with strategic buyers. And the last piece is just heavy tax counsel involvement in your term sheet, especially if you're getting stock consideration. Want to make sure that you're not getting a terrible tax outcome. So it really is important to bring counsel in to think that through, and counsel that has a good tax team.
And you just saved a deal for us on that, Meredith, where the tax, the way the offer was structured would just not have worked from a tax standpoint, and your team helped restructure
I'm
it.
working with some of your colleagues in real time to try to save deals. I hope.
Well, we're optimistic. Ellie, were you going to say something on this?
Nope, she is the expert here. The only thing I was thinking is earnouts. We did not cover, but
We
it's just-
should.
yeah.
How do you think about an earnout? They're very tricky.
Well, investors universally hate earnouts. I mean, I guess there are always edge cases, but usually we view it as, or oftentimes you'll see it offers that aren't real offers, or that's how we view it. Like, this isn't a legitimate offer when it's like 20% consideration and then 80% earnout. That's just essentially completely disregarding the cap table. So, and not to mention for the founders, how real are those earnouts? But it's important to be aware and communicate clearly that that's not what you're looking for, and it's not going to be something that's going to be approved. If it's a small piece of the overall and it's part of the compensation for the team, that's a different thing than when it is, I've seen the whole range. It can be bundled in, and sometimes even the rolled equity is a piece of that, which is to me insane. But it's another point of the kind of where the different alignment of the different folks becomes quite clear.
Yeah, earnouts we're seeing a ton in the current market. They should be paid to the whole cap table and not just to the employees. And they need to do that in order to be taxed appropriately. But in the current market, they're bridging valuation gaps. I see investors getting on board with them only when they're okay with the upfront price and basically okay with the earnout's a nice sweetener if you get it. They're often not achieved just because you don't control the company after you sell it. There's a lot of room for dispute. They frequently litigate and settle when they're not earned. So that's the joke among lawyers is never earned, always paid, but they're not paid in full. And you have to fight for them.
Yeah,
so
we
avoid
essentially
if you can, or view it as a sweetener.
Right. We value our piece of them almost universally at zero.
So I will say that we have had some better luck with earnouts, and maybe that's because we only advise on them when we can structure them in such a way where there is, first of all, not a cliff, but a collar, where there's a lot of room for getting close to your target and still getting a significant payout, and that they're based on something that's very controllable by the seller, so that we are sure that it's a number, whether it's the type of sales that they do if they're going into a large company that does other things, but a way that, you can actually control the ability to meet that number. But we actually, every so often, and it's, I always say bankers are very aligned with our clients, because of course our success fees are almost, is almost entirely what you're paying is just based on what we're able to bring to you. And we are often getting these surprises of, they earned another earn out 3 years later. It's just beautiful, and so it's very nice for us to see that. So we think these earnouts can get achieved. So we're not as universally against them. I will say when I was on the buy side, I found them very, very hard to structure. And I would agree that most of the time, if you just let a buyer structure the earnout how they would want it, it is not something you'll ever achieve and not something you would ever want.
So we're over time. I know there's a ton more to talk about, but I'm really glad we did this. And obviously we're all open for further conversation and question, ping us. Joanna, Ellie, thank you for doing this.
Yes, thank you so much, Meredith. Thank you, Ellie. It's wonderful.
Fun.